November 7th, 2025. China's Ministry of Commerce issues document number 68. 14 pages of regulatory language, dense, bureaucratic. The kind of document most people scroll past without reading, except buried on page 9 is a single paragraph that could reshape the entire global silver market. Starting January 1st, 2026, China will implement state trading management for silver exports. And here's the kicker. To qualify for an export license, companies must produce at least 80 tons of silver annually. 80 tons. That's 2.57 million ounces. And if you're operating in China's western regions, they'll graciously lower the threshold to 40 tons. How generous. But let's be clear about what this actually means. This isn't a ban. It's something more sophisticated. It's a gate. And China just made the gate so narrow that only state-approved giants can pass through. Every small exporter, every independent mining operation, every regional producer that ships 20 tons, 30 tons, 50 tons annually, they're all cut off, blocked, eliminated from the international market starting January 1st. And the timing? China accounts for roughly 13% of global silver mine production. That's 109 million ounces annually. But here's what nobody's talking about. China doesn't just mine silver. China controls the flow of silver. They're the world's largest refiner, the largest processor, the largest industrial consumer. And they've been flooding Western markets with refined silver while simultaneously building strategic stockpiles domestically. Shanghai Futures Exchange inventories hit a 10-year low of under 600 tons in November 2025. That's not because China doesn't have silver. That's because China is hoarding it. And now, with this 80-ton production threshold, they're making sure that whatever silver does leave China leaves through entities they control completely. Let me show you exactly how this mechanism works, why the 80-ton threshold isn't arbitrary, what this means for global supply chains already running on fumes, how this connects to a much larger geopolitical strategy, and why this might be the trigger that finally breaks the paper silver market. Because if you think this is just about export licenses, you're missing the forest for the trees. This is about control. And when the world's second largest silver producer decides who can export and who can't, they're not just regulating trade, they're weaponizing supply. First, let's decode the 80-ton threshold because this number was chosen very deliberately. China produced approximately 3,300 metric tons of silver in 2024. That's 106 million ounces. Now, silver mining in China isn't like Mexico or Peru, where massive primary silver operations dominate. Most Chinese silver is byproduct. It comes from lead zinc mines, copper mines, gold operations. Hundreds of small and medium-sized producers across multiple provinces, each contributing modest amounts. When you set the threshold at 80 tons per year, you're not just raising standards, you're eliminating competition. Because in China's fragmented mining sector, very few producers hit 80 tons from a single operation. You're looking at maybe 15 to 20 companies total that qualify. State-owned enterprises, large mining conglomerates, entities with deep connections to Beijing. Everyone else, shut out. And here's the beautiful part. If you're the Chinese government, those small producers don't disappear. They keep mining silver. But now, instead of exporting directly, they must sell to the big state-approved companies. At prices, the big companies dictate. The consolidation happens automatically. The state doesn't need to nationalize anyone. They just changed who's allowed to play in the export game. And wait, you might ask, doesn't China want export revenue? Why would they restrict their own companies from selling internationally? Great question. And the answer reveals the strategy. China doesn't need export revenue from silver. What China needs is silver. Physical silver for solar panels, electronics, 5G infrastructure, electric vehicles, all the technologies powering their industrial dominance. Domestic silver demand in China exceeds 50% of global industrial consumption. That's not a typo. Half of all the silver used industrially worldwide gets consumed in China. So when Shanghai inventories fall to 10-year lows, when domestic prices are surging, when Chinese manufacturers are screaming for metal, the government has a choice. Keep exporting to earn dollars, or keep the metal and ensure domestic industry doesn't grind to a halt? They chose the metal, and the 80-ton threshold is how they're implementing that choice without calling it a ban. Now let me show you what this does to global supply, because the numbers get scary fast. In October 2025, China exported a record 660 tons of silver. That's 21.2 million ounces in a single month. Most of it went to London and New York, filling depleted COMEX and LBMA inventories that were screaming for metal. Those exports temporarily relieved Western shortages. They prevented lease rates from spiking even higher. They kept the paper markets functioning. Starting January 1st, that flow gets choked. Not eliminated, but dramatically reduced. Because the small and medium exporters who collectively shipped maybe 30% to 40% of those October volumes are now blocked. The large state companies that remain qualified, they'll export whatever Beijing tells them to export. No more, no less. Analysts estimate that Chinese silver exports could fall 50% or more under the new system. That's a loss of 300 to 400 tons monthly. Annualized, that's 3,600 to 4,800 tons. In ounces, that's 115 million to 154 million ounces of silver that previously flowed to global markets and now stays in China. The global silver market already runs a structural deficit of approximately 96 million ounces annually, according to Silver Institute data. That's the 5th consecutive year of deficit. Total supply, including recycling, is around 1.05 billion ounces. Total demand exceeds 1.2 billion ounces. The gap gets filled by drawing down above-ground inventories, COMEX vaults, LBMA vaults, ETF holdings, strategic stockpiles. But those inventories aren't infinite. COMEX registered silver fell to 40 million ounces in mid-2025 before recovering to 113 million ounces by December. That recovery? China's October export surge. And now that surge is being cut off. If China reduces exports by 100 to 150 million ounces annually, as analysts project from the 80-ton threshold choking small exporters and the existing 2025 deficit is 95 million ounces per Silver Institute data, the new deficit could hit 250 million ounces. That's a massive 200 plus million ounces of silver that global markets need but can't source. Every year, compounding. At that deficit rate, COMEX registered inventory gets depleted in 4 to 5 months. LBMA's free float, already down to 155 million ounces in September, disappears in 6 months. The system runs out of readily available physical silver before the end of 2026. And here's where it gets interesting. Because when physical supply disappears, one of two things happens. Either prices explode to ration demand, or the paper markets decouple from physical reality entirely. Let me show you the comparison to 1980, because the setup is eerily similar. In 1980, when the Hunt brothers tried to corner silver, COMEX changed the rules. They implemented position limits. They forced liquidation-only trading. They protected the shorts by preventing new long positions. The system survived by destroying price discovery. In 2025, we're approaching a different kind of corner, not from speculators demanding delivery, from industrial users who actually need the metal and can't get it. When Toyota needs silver paste for solar panels and Perth Mint has 16-week delivery times, when Samsung needs silver conductors for electronics and dealers are quoting $8 premiums over spot, that's not speculation. That's structural shortage, and COMEX can't solve structural shortage by changing margin requirements. You can force speculators to liquidate. You can't force solar panel manufacturers to stop needing silver. So what happens? The paper market, where billions of ounces trade annually, slowly loses credibility. Physical buyers stop referencing COMEX prices because COMEX prices don't reflect physical availability. They start paying whatever it takes to secure actual metal. Premiums widen from $5 over spot to $10, then $15, then $20. Eventually, the paper price becomes meaningless. This is the breaking point that China's policy might trigger, not by attacking the paper market directly, by removing physical supply until the paper market's fractional reserve structure collapses under its own weight. Now let me show you the geopolitical dimension, because this isn't happening in isolation. In 2023, China restricted exports of gallium and germanium, critical materials for semiconductors. In 2025, they tightened controls on tungsten and antimony, essential for defense applications and batteries. The pattern is clear. China is systematically cutting off critical material exports, forcing Western industries to either build alternative supply chains or submit to Chinese terms. Silver is different from those materials in one critical way. Scale. Gallium global production is 340 tons annually. Germanium is 155 tons. Tungsten is 84,000 tons. Silver is 27,000 tons annually, or 845 million ounces. The economic impact is orders of magnitude larger. And silver isn't just defense or semiconductors. Silver is everything. Solar panels need silver paste. Electric vehicles need silver contacts. 5G towers need silver connections. AI data centers need silver-plated components. Medical equipment needs silver coating. Water purification needs silver compounds. This is the metal that enables the entire green energy transition and the entire technology sector simultaneously. When China controls who exports silver and how much, they're not just managing a commodity. They're controlling the pace of Western industrial development. They can slow the solar build-out in Europe by restricting silver supply. They can delay EV production scaling in America by hoarding refined silver. They can make 5G expansion in Japan more expensive by forcing bidding wars for available metal. This is economic statecraft. And the 80-ton production threshold is the mechanism. But wait, here's where it gets even more complex. Because China isn't just restricting exports. They're simultaneously buying physical silver internationally. Indian silver imports hit 1,700 tons in October 2025 alone. Where's much of that silver going? To Chinese buyers through intermediaries. Reports suggest China has accumulated significant undisclosed silver reserves while publicly restricting domestic inventory data. This is the same playbook they used with gold. Publicly report modest official holdings while secretly accumulating through state banks, sovereign wealth funds, and strategic enterprises. When the accumulation is complete, they revalue the holdings upward and reveal the stockpile. Instant wealth transfer from west to east. If China has been accumulating silver through back channels while simultaneously restricting exports, they're building the ultimate squeeze. They control production through mining. They control processing through refining. They control exports through licensing. And they control demand through industrial consumption. At some point, probably when Western inventories hit critically low levels, China reveals they're sitting on massive stockpiles. Physical silver that the paper markets assumed was available suddenly isn't. The entire fractional reserve structure built on the assumption of Chinese supply collapses. Prices gap up violently, and China's undisclosed holdings appreciate instantly. This isn't conspiracy, this is strategy. And document number 68, with its 80-ton threshold, is a piece of that strategy executing in real time. Let me show you who wins and who loses from this, because the wealth transfer is already in motion. Winners: Chinese state enterprises. The 15 to 20 companies that qualify for export licenses now control a monopoly on Chinese silver exports. They buy domestically at suppressed prices from small producers who have no export option. They sell internationally at elevated prices to desperate buyers. The margin is massive, and it's guaranteed by regulation. Winners: physical silver holders outside China. Anyone holding allocated silver in non-Chinese vaults, Swiss storage, Singapore storage, private vaults, they're sitting on an asset whose supply just got dramatically restricted. As Chinese exports fall and Western inventories deplete, physical premiums will widen. What's worth spot plus $5 today might be spot plus $20 in 6 months. Winners: non-Chinese silver miners. Companies operating in Mexico, Peru, Chile, Poland, Australia, they just got a massive competitive advantage. With Chinese supply restricted, global buyers have nowhere else to turn. Mining companies can command better terms, higher prices, and strategic partnerships. Stock prices for First Majestic, Hecla, Fresnillo, they all surged 40% to 90% in late 2025 as this became clear. Losers: Western manufacturers dependent on silver. Samsung, Toyota, Tesla, Siemens, every company that needs silver for production and doesn't have long-term supply contracts locked in, they're about to get squeezed. When spot silver is $65, but physical delivery is 12 weeks out with $12 premiums, and you need metal next month, you pay. And you pass those costs to consumers, or you eat them as lost margin. Losers: paper silver holders. Anyone holding silver ETFs that aren't fully allocated, anyone holding COMEX futures expecting to roll them forward indefinitely, anyone holding bank certificates representing silver, they're discovering that paper claims are not the same as physical metal. When the supply crunch hits, when premiums explode, paper might settle at spot while physical trades $30 higher. That spread is your loss. Losers: the COMEX system itself. Because if this policy triggers physical delivery demands that COMEX can't fulfill, the exchange faces an existential crisis. They either default on contracts, which destroys credibility permanently, or they force cash settlement, which proves the paper market is fiction. Neither outcome is good for COMEX's future as a price discovery mechanism. The timeline is compressed. January 1st, 2026. That's when the new licensing rules take effect. We're talking weeks, not months. Small Chinese exporters are already winding down international sales. They're redirecting metal to domestic buyers or large state companies that will handle exports. The flow is already slowing. By March 2026, the full impact hits global markets. Western inventories that relied on steady Chinese supply start drawing down faster. LBMA free float falls below 100 million ounces. COMEX registered inventory trends toward 80 million. Lease rates, which spiked to 11% in October, spike again, maybe 15%, maybe 20%. Physical premiums widen. What's $5 over spot in December becomes $8 in January, $12 in February, $18 in March. Delivery times extend. What's 8 weeks in December becomes 16 weeks in March, 24 weeks by summer. Dealers run out of inventory. Mints suspend production because they can't source blanks. By mid-2026, if the deficit projections hold, we're in full crisis mode. Industrial buyers bidding against each other for available supply, governments invoking strategic reserve clauses, and the paper markets, desperately trying to maintain credibility, face delivery demands they can't fulfill. What happens then? That's the trillion-dollar question. Does COMEX change rules like in 1980, forcing cash settlement and destroying their own legitimacy? Does physical silver decouple permanently from paper prices? Do Western governments impose their own export restrictions, fragmenting the global market into regional blocks? Or does something unexpected happen? China, having achieved maximum leverage, offers to resume exports in exchange for concessions, technology transfers, trade agreements, geopolitical alignments, using silver as a bargaining chip in negotiations that have nothing to do with silver itself. This is how resource wars function in the 21st century. Not tanks, not bombs, export licenses, production thresholds, strategic stockpiles. China just demonstrated they understand this game better than anyone. Now, let me address the obvious counter-argument because I can already hear it. But China needs export revenue. They won't actually restrict silver because it hurts their economy. Here's why that's wrong. First, silver exports represent a tiny fraction of China's total export economy. Even at 660 tons monthly, that's roughly $1.3 billion annually at current prices. China's total exports exceed $3.5 trillion. Silver is 0.04% of the total. They can afford to sacrifice silver export revenue if it serves strategic interests. Second, the revenue they lose from restricted exports they gain from higher domestic prices and international price increases. If restricting Chinese supply drives global silver from $65 to $100, Chinese miners make more money per ounce sold domestically. The math works in their favor. Third, and most importantly, the strategic value of controlling silver supply exceeds the export revenue. If restricting silver slows Western solar deployment, delays EV production, or forces technology concessions, that's worth far more than $1.3 billion in export sales. This is economic warfare, and in warfare, short-term costs are acceptable for long-term strategic gains. The people designing this policy aren't commodity traders optimizing revenue. They're strategic planners optimizing leverage. And document number 68 is the result. Let me end with a connection to the bigger picture, because this policy doesn't exist in isolation. It's part of a system, a global silver control system that most people don't see because they're focused on the wrong metrics. Everyone looks at mine production. Mexico mines 202 million ounces, China 109 million, Peru 107 million. But mine production is a distraction. The real control happens in three other layers. First, the byproduct paradox. 72% of silver is mined as a byproduct of copper, lead, and zinc operations. That means silver supply doesn't respond to silver demand. It responds to base metal prices. When copper is profitable, you get silver. When copper crashes, silver supply falls. And who controls copper? A handful of diversified mining giants, BHP, Rio Tinto, Glencore. They set copper production based on copper strategy. Silver is just along for the ride. Second, the refining choke point. 3 Swiss refiners, Heraeus, Valcambi, Metalor, process the majority of global silver supply. If you can't get your silver refined to exchange standards, you can't deliver it to COMEX or LBMA. The refiners are the gate, and they're operating at capacity. Third, the exchange control. COMEX and LBMA set the rules for what constitutes deliverable silver. They determine vault requirements, purity standards, bar specifications, and both exchanges operate with minimal physical inventory relative to paper claims. COMEX registered inventory is 113 million ounces against open interest, representing 650 million to 900 million ounces. LBMA free float is 155 million ounces against daily trading of 2.1 billion ounces gross. The leverage is insane. And then there's the silent accumulator, JP Morgan Chase. Multiple sources tracking COMEX warehouse movements estimate JP Morgan has accumulated close to 1 billion ounces of physical silver since 2011. If those estimates are accurate, that's roughly 9% of all above-ground silver. One bank holding nearly 1 billion ounces, with the ability to release supply or withhold it based on their own strategic interests. This is the system. Byproduct mining controlled by base metal companies, refining controlled by 3 Swiss firms, exchanges operating fractional reserves, and one American bank potentially holding a strategic stockpile. Now add China's new export restrictions, removing 120 million to 150 million ounces from global flow. The system was fragile before document number 68. Now it's breaking. And when it breaks, when physical demand overwhelms paper supply, when inventories deplete, when lease rates spike to 30%, when premiums hit $25 over spot, control shifts entirely to those holding physical metal, not paper contracts, not ETF shares, not bank certificates, physical silver, allocated, outside the banking system. That's what matters when the system breaks. China understands this. That's why they're implementing the 80-ton threshold. They're securing physical control while the West is still playing paper games. The question isn't whether the system breaks. The question is whether you're positioned correctly when it does. If you want to understand who actually controls the world's silver supply, the hidden mechanisms, the concentrated power, and why this market is more fragile than anyone admits, you need to watch my deep dive breaking down the entire control structure. It's called Who Really Controls the World's Silver, and it exposes the byproduct trap, the refining bottleneck, the exchange leverage, and JP Morgan's billion-ounce position. Everything connecting to what I just showed you. Link in the description. Because China's export restrictions are just one pressure point. The entire system is under stress. And understanding who holds the real power is the difference between surviving what's coming and getting crushed by it. Document number 68 is 14 pages long. The paragraph that matters is on page 9. The threshold is 80 tons. The date is January 1st. And the implications are only beginning to unfold. China just built a gate. Only the giants passed through. And the world's second largest silver producer just decided to keep most of their metal home. The supply crunch isn't coming. It's here, and it's accelerating. Position accordingly.